Hi guys, welcome to a simpler approach. If you are new to the channel, please subscribe, like, comment and share. In this video, we will be looking at limited liability companies. Now we will have to split this topic in two parts. In this week, we will be looking at the theoretical aspect of limited liability companies. And next week, we will look at the financial statements relating to limited liability companies. Now, it is essential to separate the two simply because the theoretical aspect of limited liability companies can be quite lengthy, and as such, we will take adequate time to understand the theoretical aspect first, so that next week we will be able to apply the theoretical aspect to the practical aspect. So, without further ado, let's get started. Our objectives for this lesson includes an understanding of the theoretical aspect, especially of limited liability companies, and we seek an understanding of the concept of shares. Now, in order to provide a simple understanding to this topic, we will be taking our time as we approach the theoretical aspect of limited liability companies. Hopefully this video will not be too lengthy, but at the same time we cannot sacrifice going too fast and not understanding the theoretical aspect that is crucial to understanding the practical aspect. So, without further ado, let's take our time to understand limited liability companies. In order to understand the limited liability companies, we must first seek to understand limited liability. We must understand that concept first. Now, limited liability literally means that the liability of each member of a limited liability company, their obligation is limited to the amount of money that they invest in the company. To make this shorter and simpler, limited liability means limited obligation. An obligation comes from what is expected of you in the entity. So, if the entity should face bankruptcy, if it's going to be terminated, then the members of the entity will only lose that which they have invested into the business. Their personal assets are not at stake. Okay? Now, if it is that at the point at which the company is being terminated or being wound up or it's becoming insolvent or anything like that, if it is the shareholder did not pay up their full aspect of shares, in other words, if they didn't pay all the monetary obligations that they were supposed to while being a member, they will be required to pay that up. Apart from that, nothing else will be required of them. They will only stand to lose that which they have invested. Okay? Now, with this in mind, limited liability companies are organizations that are owned by shareholders. Okay? The capital of a limited liability company is referred to as share capital. It is referred to as share capital simply because the capital comes from the selling of what we call shares. Now, a share is a single unit of ownership, or it's a unit of total capital in an entity. Now, to be a shareholder, you simply purchase a share. And usually, purchasing a share automatically means that there's a cost affiliated to it. Okay? Now, people don't just buy shares like that and it stops there. There must be a reward for purchasing shares. Therefore, dividends are the reward that is paid to shareholders as a result of purchasing shares. Okay, so once you're a shareholder, you are entitled to dividends, and dividends is your reward. We will dive into these two things a little bit deeper further down in our lesson. Okay, now there are two types of limited liability companies. First is the private limited company. Now, this company is usually family owned. Okay, and by family owned we mean that it is passed down from family to family. It's in a lineage. If we're going to grab at some examples, then we're looking at Hazans, for example. You know, that kind of store kind of thing. Yeah, let's use that as an example. So it's a family owned business, which means it will pass down from generation to generation within the family lineage of the Hazans. Okay, now the thing with this kind of or this type rather of company is that, one, they can have a minimum of 2 shareholders and a maximum of 50. 2, they do not offer their shares to the general public. Shares are offered to other family members or very close friends, and because of that, it makes the process of transferring shares very, I'm not going to say impossible, but let me say tedious. It's not easily transferable because it usually stays within the family or very close friends. Okay? Thirdly, there is no requirement to issue a prospectus or to publish their financial accounts. We will get the prospectus, but let me just give you like a synopsis. A prospectus rather, is a very attractive booklet that outlines key aspects of the entity, including shares that are available, how much for these shares, how to acquire them, so on and so forth. Okay, so the private limited company is not required by law to issue that prospectus, and they are not required by law to publish their accounts. Okay, so that takes care of the private limited company. The other type is the public limited company. Now, the public limited company, number one, they raise their capital by issuing their shares to the general public. As long as you have the money to purchase shares, you can purchase shares. There is no limit or no cap on it. Okay? Which also makes the transfer of shares very easy. Seeing that anyone can purchase it, that means you can transfer it to anyone. Okay? Secondly, by law, private limited companies are required to issue a prospectus, and they are required to issue their financial statements. Why? Saying that the shares are being bought publicly, it means that anyone can invest or be affiliated with the entity. As such, they are required to issue their financial statements, which gives potential investors an idea of the company's financial position. Okay, so you are giving everyone an understanding of how the entity is performing, thereby giving them an informed stand as it relates to if they invest or if they do not. Okay, now in order to form a limited liability company, the following must be done. 1, you must prepare a document that is called the Memorandum of Association. This document governs the external affairs of the entity. And by external affairs, we mean things such as the company's name. What is it going to be called? With the word limited at the end. Okay? What's the address of the registered office? Where will it be? And we're talking about exact address, street number, area, parish, postal code, the whole 9 yards. Exact address. The objective of the company. Every company has an objective and a vision. but the objective is what's very much necessary in this document. The capital of the company. What will the capital be and how will the capital be acquired in terms of shares, that is, okay? Especially for public, you know, it's going to be on the, it's going to be issued to the public. So we need the type, the value, the number of shares, okay? And it must also state that the members of this company will be limited, meaning they will only stand to lose if the company should go bankrupt or in any other direction such as that. They only stand to lose what they have invested. Okay? Cool. So that's number one. Number two, a second document that is called the Articles of Association. Now, this document details the internal affairs of the company, such as who are the persons who will be in certain positions, what are their names, what are their duties, their responsibilities, the election of directors, the length of time that they should serve, etc., etc. Internal affairs. Cool? That's number two. Number three, we're back at the prospectus. And remember that the prospectus is for public companies. Private companies are not required to issue this document. Now, in greater detail, the prospectus is an attractively printed booklet. Now, it is imperative that it is attractive because this booklet is somewhat of a marketing tool. You don't want anyone to have this document or to, acquire a document and it's not, attractive, it's not well put together to catch the attention and to grab the interest of the persons who acquire it. Okay? So that is why it must be attractive. So put it together nicely with some nice colors and text and stuff. And it has background information about the company, including information relating to shares. So this information must be detailed because you want to give the readers all the information necessary to come and invest in this company. So you'd have to give the amount of shares that will be issued, the price per share, the type of share, specifics as it relates to transferring shares and, so on and so forth. Okay? Now, after these three documents are done and they are submitted to the registrar of companies, that's the company that is mandated by law to register new companies. After those documents have been submitted and the relevant fees are paid, then the registrar of companies will issue two documents to this new company. The first being a certificate of incorporation. Now, this document is like birth certificate for the company. It proves that the company was formed, the company is legal, and everything all right. The second document is a certificate of trading, which authorizes the company to start doing business. That is how a limited liability company is formed. Okay? I hope you're with me. I'm trying to move a little fast. At the same time, not jeopardizing the content and ensuring that you're understanding. Okay? Awesome. Shares. Backtrack a little bit to our introduction where we identify that a share is a single unit of ownership or a single item of capital in an entity. Now we will be looking at the types of shares, and the first one is preference shares. Now, as the term preference suggests, it means you have a little priority, okay, a little VIP thing or go on. All right, so preference shares are priority shares. Number one, it comes with a fixed rate of dividend, 5%, 8%, 10%, and it stays right there. So if you buy 10,000 shares at 5%, it stays there. 8%, it stays there. 10%, it stays there. It doesn't move. It's fixed. Okay? 2, preference shares can be cumulative non-cumulative or participating. Cumulative shares, as the term cumulative suggests, cumulative comes from the word accumulate. When you accumulate it, it pile up, don't it? In plain Jamaican terminology, it pile up, it stacks up. So cumulative shares are shares that roll over from year to year. So if you were supposed to get shares in 2010 and didn't get it, it would roll over to 2011. Same thing happens, two of them would roll over to 2012, and so on. Non-cumulative would be the opposite of that. Whatever is not paid in that year would be lost. Okay? Participative shares is where a regular fixed dividend plus a bonus is given to the shareholder. But that bonus is paid at like a certain level. All right, and the company would decide that level. Okay? Now, unless otherwise stated, preference shares are cumulative. If you don't get paid this year, it will roll over to the next year. Okay? Awesome. Ordinary share is the next type of shares. So you have preference and you have ordinary. Now, as the term ordinary suggests, it's just there. As an ordinary shareholder, you're just there. But there are perks to being an ordinary shareholder. Although preference shareholders are priority, which means that they would get paid first, there are certain perks that preference shareholders don't have. Ordinary would have that. Number one, ordinary shares entitle the owner or the holder rather to voting in general meetings. Okay, there is a certain level of power that comes with being an ordinary shareholder. Okay, there is influence in the company's affairs when you are an ordinary shareholder. Okay, those two things bear a little weight because at least you'd have a say in how the company is run, and you would have a say in voting who you would want to serve in certain capacities. That is done in the general meeting. Okay? Preference shareholders do not hold those rights. All right? I would consider those two things advantages of being an ordinary shareholder. What I would consider disadvantages is the fact that ordinary shareholders are not paid according to a set percentage. Preference shareholders have a set rate of dividend, set percentage. Ordinary shareholders do not. Now, in some ways, it's a disadvantage, but in other ways, it can be. Because for this year, you could get 5%, but next year, the company did so well that ordinary shareholders are paid 15%. So it's kind of a slippery slope as it relates to it being an advantage or a disadvantage. I will allow you to decide that one. Okay? Value of shares. Now, every share have three possible values: par value, market value, and book value. Now, the par value is the fixed stated value of each share, and this is recorded in the Memorandum of Association. Okay? Now, otherwise known as the face value or the nominal value, it is the value on which the dividend is calculated. So, for example, let's say we have 100,000 ordinary shares of $2 each. That would mean that in order to acquire one share, you would have to pay $2 for it. Okay? Likewise, if you have, say, 50,000 7% preference shares of $1 each, it means that if you wish to acquire one preference share, you would pay $1 for it, and your dividend would be 7%. Okay? So, that's par value. Market value now is the price at which it is sold on the stock market. Now, the market value can be less than, the same, or greater than the par value. Okay? Now, the book value is the value of an ordinary share based on the reserves of a company. Now, that comes with a percentage. And the percentage is issued ordinary share capital plus reserves over the number of ordinary shares in issue. Okay? Awesome. Now remember, where the issue of share is concerned, we spoke about just now market value. And we did say that the market value is the price at which the share is sold on the stock market. Now that can be less than, the same, or greater than the par value. Now, if it is sold at greater than the par value, the extra is called share premium. Now, when the issue of the share is being recorded, the par value and the share premium must be separated. What do I mean? Let us use this example to determine what we mean. Mayberry Limited has an authorized share capital of 300,000 ordinary shares of $1 each and 150,000 10% preference shares of $2 each. The company decided to issue half of the ordinary shares at $1.50 and 100,000 of the preference shares at $2.30. Now, remember that the par value of the ordinary share is $1 and it is being sold for $1.50. The par value of the preference share is $2 and it is being sold for $2.30. Okay, so you can see the extra on both sides. 50 cents extra for the ordinary share and 30 cents extra for the preference share. Now, when it is all recorded, this is what it will look like. This is what the entries in the general journal would look like. Now, if you notice, A, B, C, and D is at the side. What that means is we're going to break down everything that you're seeing there. And you can feel free to take notes. A, bank, 455,000. That represents the collection of everything. All the funds that were collected from all the issues that took place. Okay? Now notice that that comes through the bank, which means the bank will be debited. And when we say bank, we mean the business's bank account or cash book, the bank column. Okay? That takes care of that. B, the share capital collected has been broken down in three parts: ordinary shares, preference shares, and share premium. And remember, the share premium is the extra at which the shares are sold for. Now, it is imperative to separate them so that we know how much was collected for each. Okay? That takes care of B. For C, ordinary shares. Remember again that the par value and the share premium must be separated. When shares are issued for extra more than the par value and the extra, which is called the share premium, must be separated. Always remember that. So what you see there for C is the value of the ordinary shares at par. 150,000 ordinary shares at $1 each. 150,000 times $1 gives $150,000. Cool. D, preference shares. Preference shares at par was $2. The company issued 100,000 preference shares. Now at par, that would be 100,000 times 2, which is 200,000. Okay? Cool. Now, for the share premium is separated between ordinary and preference. What do we mean? Remember, for ordinary, it was authorized at $1 but sold for $1.50. So what we would do is we would calculate the 150,000 at 50 cents, because 50 cents is the extra. Okay? So 150,000 multiplied by 50 cents gives us $75,000. So that was the extra for ordinary shares. Okay? Rest that over here so in your brain. Now for preference was sold for $2.30. The 30 cents is the extra. So 200,000 multiplied by 30 cents gives us $30,000. Put that over here, so. Okay? Now both refer to share premium because they are excess for ordinary and excess for preference. Now when you record it, you just add the two. 75,000 plus 30,000 is 105,000. There you go. Now when you add all three together, that is how we get to $455,000. Oh, and remember, double entry is taking place right here. So share capital is credited, bank is debited. Therein, you record the issue of shares. In a limited liability company, capital is divided into 6 categories. Authorized or nominal capital, number 1. That's the maximum amount of capital that a company takes power to issue. Now, when we say takes power, it means that they record it in their Memorandum of Association. And once it is written in the Memorandum of Association, it means that would be their ceiling. They cannot go above that. That would be the farthest they can go legally. Okay? In terms of the amount that they can issue. All right? Now, issue capital is the actual amount of share capital that is issued by the company. Now, it is possible for shares to be issued to shareholders or investors on the understanding that when the time is right, the funds will be called for, the funds will be requested, or it can be paid in installments. Okay? So that's issued. Called up is the amount that they ask for. Now remember, we said with issue that the shares can be issued with the understanding that at a certain time it will be called for. So called up is the amount of share capital that is called for or asked for by the company. Paid up capital is the amount now that is received in hand, as the term paid up suggests, the amount that has been paid, received in hand by the company. And when we say in hand, we mean loosely. We mean the amount that they have recorded receiving money in the bank and something. We have collected it. Okay? Unissued now is that portion that was not issued in the first place. It's still available. It's still there. And uncalled is that part of the issued that has not yet been asked for by the company. So when the shares are issued, they would have called for a section of it. That's the called up part. And then when you have called for it and have received the payment, that would have been the paid up part. The part that they have not called for just yet is called the uncalled amount, and the amount of the authorized that is not yet issued would be called the unissued. Okay? So those are the 6 categories of capital. The concept of debenture lies in the concept of borrowing. Everybody borrows money at some point or another, and companies do the same. Now, debenture is the document that outlines the terms and conditions upon which an entity can borrow money. Now, there are 3 things we must know about debenture. Number 1, debenture, like preference shares, carries a fixed rate. Preference shares carries a fixed rate of dividends, while debentures carry a fixed rate of interest. Also, the process of recording the issue of debenture is the same as the process of recording the issue of shares. Okay, that's thing number 1. Number 2, the interest paid on debentures is an expense and is not an appropriation item. Now, I will show you that in greater detail when we get to the financial statements and we're writing it up. You will get a better understanding of what that means. Okay, that's 2. And 3, the interest that is paid on debenture must be paid whether or not the company makes profit. Whether profits are made or not, debenture interest must be paid. Cool? So those 3 things you must know about debenture. And finally, dividends. Now, the reward that shareholders receive as a result of purchasing shares is in the form of dividends, and dividends are paid on profits. Okay? Dividends are due at the end of the period, but it can be paid before or after or even at the end of the period. All right? Now, when dividends are paid before the end of the accounting period, they are referred to as interim dividends, and interim dividends should only be recorded in the appropriation account. Once again, when we get to financial statements and we're doing the appropriation account, you will see what it looks like and you will see that in greater light. Okay? Now, when dividends are paid after the end of the accounting period, they are referred to as proposed dividends, and that must be entered in the appropriation account when you are doing up the financial accounts for limited liability companies. That takes us to the end of a complete, as it were, theoretical aspect of limited liability companies. Next week, we will be joining all of this together and we'll be marrying. I'm thinking if that term can work. Yes, we'll be marrying them. We'll be joining them together. The theoretical aspect and the practical aspect. Now remember, all the things that we have looked at in this lesson, you must remember them so that when we are putting the financial statements together, we will be able to remember these things so that when we put the financial statements together, everything will flow and come to light in a greater way. So, see you next week. If you enjoyed that video, please subscribe, like, comment, and share. And please click that notification bell so that whenever I upload a video, you will be the first to know. And as always, if you have any concerns, queries, questions, whatever it is that you have, please feel free to share them in the comments section below and I will respond to you directly. Until next time, walk good, stay safe.